Welcome to topic 8, Fringe Benefits Tax. So fringe benefits tax is something that is imposed not on the employee who receives the fringe or non-cash benefit in lieu of salary, but it's imposed on the employer. It's assessed under the Fringe Benefit Tax Assessment Act, and it was created in 1986 because what was happening, of course, is that a lot of people were creating salary package arrangements where they were getting non-cash benefits like cars and computers, and therefore those amounts weren't being counted in their income, they weren't being recorded in their tax return, and they weren't paying tax on it. So FBT covers a wide range of these non-salary benefits that are provided to people due to their employment. There are 13 different types. They all get valued differently, and we're going to talk about some of the main ones that you're going to come across. So essentially, a fringe benefit tax, the amount of tax you're going to pay, is the rate for that particular year multiplied by the taxable amount of that benefit. Now, be aware, the fringe benefit tax year is different from the regular financial year. It runs from April to March, and the rate changes, and it is linked to whatever the highest marginal rate is for an individual. So that currently means that in the 15-16 and 16-17 years, we're looking at a fringe benefit tax rate of 49%. So employers are required to self-assess and report their fringe benefits tax. They have to lodge a fringe benefit tax return by the 21st of May. So the fringe benefit tax year ends on the 31st of March. They have 2 months basically to lodge their return, or if they have a later date that the commissioner has allowed them, then they're allowed to lodge whenever they have been told. But generally speaking, for most, it's the 21st of May. Generally speaking, because it's linked to salary packages and employees are reporting these amounts or reporting salaries and wages quarterly in their business activity statements, it's normal to see them also reporting and paying quarterly installments of fringe benefits tax on their business activity statements. Those installments will then be credited against their total liability at the end of the year. If they have underpaid in their installments, they're going to have a payable amount to the tax office. If they have overpaid, they're going to get a refund. The fringe benefit tax and the cost of all the benefits are costs of running a business. They are business expenses, and so they are tax deductible in the employer's tax return. So what is a fringe benefit? It's where a benefit has been provided during the year by the employer to the employee or an associate of them under some arrangement, and it's related to their employment. It doesn't include things like your actual salary. It's meant to be for the non-cash benefits. Doesn't include superannuation, doesn't include employee share schemes. There are some benefits that are clearly fringe benefits but are exempt. So certain loans, some car expenses, some minor benefits, so if it's less than $300, and tools and equipment that are used for your employment. The major categories, we said there are 13 categories. Here are the major ones. The major ones you're going to see really is cars. You might have a loan that's exempt, but there might be a waiver of debt, a loan at a very low interest rate or a very beneficial interest rate, some payments of expenses, payments for housing costs, living away from home allowances, airline transport, board or meals and entertainment, tax-exempt body entertainment, so those not-for-profits providing entertainment value for people, car parking, property, and residual. The first thing you have to do is that each kind of fringe benefit has its own valuation rule. Sometimes there's a concessional treatment to providing a benefit that is in-house. Like, for example, if you were a car dealership and you provided a car, clearly that's something to do with it. Not only is it providing a benefit, but it's also helping your marketing. So it's a bit of an in-house benefit. So there's special concessional treatment that can apply in that case. Sometimes there are unreimbursed contribution, so perhaps the person pays back some of the benefit themselves. Then we can talk about the otherwise deductible rule, which means if the employee had paid the expense themselves and it would have counted as a deduction in their regular tax return, then it is a benefit that we would call otherwise deductible. So if it hadn't been provided by the employer, it would otherwise have been a deduction in the tax return of the person paying the expense. And those reductions get subtracted from the taxable value, which is the number on which we would end up calculating ultimately the tax that the employer has to pay. Like we said, this otherwise deductible will apply generally only to things that the employee could have claimed if they'd spent the money themselves. So it only really applies to, say, a loan, expense payments, airlines, board, property, and things like that. How do you calculate a fringe benefit amount that you pay the tax on? First, you calculate the taxable value of the benefit. And it will depend how you do that, will depend on which kind of benefit you have. Then you divide it into type 1 and type 2. Type 1 benefits had GST on them. Type 2 benefits don't. Step 3, you gross them up. Type 1 benefits have a particular gross up rate and type 2 benefits have a lower gross up rate. Then you add, if there is any, aggregate non-exempt amounts for that employer. So for example, here you can see how the gross up rates have changed. One of the most common ones is going to be the car benefit. You've got a choice here. You can use the statutory formula or the cost basis to calculate your tax. A car benefit statutory formula is 0.2 times the base or cost value of the car and transport to get it ready for use, times the number of days the employee had it, divided by the number of days in that fringe benefit tax year, minus any re-contribution that the employee made. That'll give you a taxable value. Taxable value for on cost basis is the cost of running the car, including depreciation and interest, minus the business use percentage, and then minus any recipient or employee re-contribution to the deal. With a debt waiver, the taxable value of the debt waiver fringe benefit is the amount that's of the debt that's been waived. So that's an easy calculation. For a loan, the taxable value is the notional interest minus the accrued interest. Generally, your notional interest is the interest rate that would have happened at a statutory interest rate, which you can find on the ATO website. And again, this operates according to the otherwise deductible rule. So there's a notional interest or statutory interest rate minus the difference is the loan benefit you're getting is the discount you're getting on the interest rate, really. So the difference between the notional or statutory rate and the actual or accrued interest rate. It will be different if you've got pre-86 loans. There will be some special rules you'd have to look up. Expense payments. So the taxable value is usually the value of the expense. For a housing benefit, it will depend a bit on whether it was remote, non-remote, outside Australia, and who provided it. Living away from home allowance. If you maintain a home and you're like a fly-in, fly-out, drive-in, drive-out, it's the allowance that you've provided the employee less the accommodation and less any exempt accommodation and exempt food. Otherwise, it's just, if there's no exempt portions, then the taxable value is the amount of the allowance you paid them. Airline transport. So this is for people generally who work in places like Qantas, so they're getting a discount. They're paying very little for their air transportation. So the taxable value is 75% of the standby airline travel value. The standby value is, for a domestic route, 50% of your lowest economy fare that has been advertised that year. For international, 50% of the lowest of your single economy fare advertised for that tax year. So it's 75% of 50% of the lowest fare available that year. Board benefit cover is usually under certain industrial agreements. The taxable value is usually $2 per meal if you're 12 and older, or $1 a meal if you're younger than 12. Meal entertainment benefits. So you can choose here a 50-50 split or a 12-week register percentage. It's like the old car logbook method. You keep a logbook and record the value. Tax exempt applies basically to our charities. So the taxable value, again, is just basically the expense that you incurred. Car parking benefits, there are 5 methods again. You can base it on what the commercial parking rate at the nearest car park is. You can try to work out a market value, an average cost. You can use a statutory formula, or you can keep 12 weeks of records. With property, it depends if it's in-house. So if you're in the business of real estate or development and you've provided access for an employee for a period of time, or if it's external and unrelated to your actual operations of business. And again, otherwise deductible rule. Other residual benefits operate again on the otherwise deductible rule, and again it depends on whether we've got in-house or not. There can be some option to use relaxed rules for calculating your FBT, and you can calculate by reference to a base year. Generally, FBT tax that you pay is a deduction. Tax-exempt employers can't use a deduction because they don't pay tax. And there are special rebates available to a rebatable employer. There's also some anti-avoidance rules. So obviously the Commissioner doesn't appreciate people entering into arrangements to reduce their liability when that's the sole purpose of the arrangement. And if so, they can just look through the arrangement and impose a penalty tax as well. Salary packaging distinguishes between whether it's effective or ineffective. Employers need to convert the cost of providing the benefit into a salary amount to include in the arrangement. They're not always beneficial to employees. They're most beneficial when you're talking about exempt benefits or concessional things. So the most common ones that people actually use are people on high incomes using it to drop a tax bracket and get a car benefit, or people salary sacrificing for superannuation, which is exempt from FBT.